Ladies and gentlemen of the crypto space, we're live on a Monday, May 20th at 12 p.m. A little late today, a little busy at the office, but I had a thought and I needed to get that thought out to everybody. Um, okay, apples and oranges. So if everyone's looking at the crypto market as apples, what if they're really oranges? So I guess that is me a way of making a metaphor for like B2B versus B2C, business to business versus business to consumer. So in my opinion, the biggest misconception of crypto markets is that they're actually meant for the general public. Now, the general public is obviously coming to the space looking for opportunity from an investment perspective, and they're trying to digest what these financial products are, what these financial primitives are. Now, I don't know. It's impossible to know everyone's individual experience and career and whatnot, but I spent a fair amount of time in customer service. General public is incapable of balancing a budget, managing a checkbook. Credit cards are intimidating. You need customer service for the silliest things quite often. So a great misconception, in my opinion, is that these products that we engage with in these crypto markets need to get better in the user interface such that consumers can consume them better. I disagree. I think these products are meant for businesses. I think the biggest short-sighted perspective of these crypto markets is that they're B2C, business to consumer. They are much more business to business. And if you think about it from that perspective, the total addressable market just went up enormously. Because if these are intimidating user interfaces, intimidating financial products and services, it's a relatively limited addressable market. But if you put in that intermediary, that business, that consumer-facing business, that obfuscates and translates these sophisticated products and services into consumer-friendly products and services, now all of a sudden it becomes consumable. So all in all, my general sentiment is all of these sophisticated products and services, what have you, Curve, Aura, Convex, even got Bunny up here, Warden and voting. The general public's not doing voting. The general public is resetting their password 123 password because they forgot it. So they're not using this. Do you see this? A fraction of a penny? What does that even mean, a fraction of a penny? The second the general public sees a percentage sign, what is a percent? General public can't do percentages. It's a minority of the population that can process what a percent is. And that's not demeaning. It's just, I've done customer service. One time, I was doing customer service. I have two stories from customer service years. One, so you have a alphanumeric keypad on a credit card terminal, and there's an alpha button, and to switch between the numbers and the letters. So, you press 1, but 1 has like A, B, and C. So in this instance, 1 had A, the third letter was Q. So, or let's just tell the story. So I had to get the user to enter a letter. I said, sir, why don't you go ahead and press the alpha button, and then the number, where was it? The number 1 2 times, and then the alpha button. And then I'm like, sir, what do you see on the screen? Noah, I see a little O with a line through it. And I'm thinking to myself, sir, that's a Q. So that's story number 1. Anywho, so number 2 was, Noah, I'm trying to set up my credit card terminal, and nothing's working. I'm pressing the buttons and nothing's happening. Can you help me out? I'm like, sir, is the power cord attached? And then the person said, damn, Noah, I knew I forgot something. You need to understand the general public, the population. to really get a sense of where these crypto markets are heading. People are looking for apples and they're looking at oranges. I don't know if that's the reverse of what I opened the stream with, but that's not the point. The point is, these are sophisticated financial products and services, and I'm not excited for consumers. I don't think that's relevant at all. I'm excited for businesses that want to use these products to build products that are consumer facing. Now, frankly, these are non-bank products that offer financial services, that offer credit, and that offer, you could say, capital management, more so than investment opportunity. But like if you're depositing capital and it's a liquidity position, and they finally get these stupid regulations sorted out, that business isn't a custodian. They don't hold anything, and technically, the software that's doing the LP functionality isn't a human. So if they get their heads out of their asses at the regulatory level, that changes the entire structure of with regard to oversight and regulation. Like who's the custodian? It's not a person; it's software. But that's probably a long way to come. It's probably a long road to get to there, and that's not necessarily a bad thing. We want these things to be right for consumers. We want these businesses to put in everything that's required in order to, one, make a product that consumers are going to consistently engage with. They build the user interfaces that are exciting and sexy and simple. They do the customer service. And so I guess probably the thought in my mind is how long? What's the time horizon for regulators to get the hell out of the way and let these businesses start making consumer-facing products and services? And that's probably like heading into 2030. It could be earlier, it could be next cycle, 27, 28. But like heading into 2030 is a significant period of time that's in my mind. One, because it's from a decade perspective. And every decade has its overarching theme to it. And that's the time frames in which I like to think. So a lot of my mindset is really from like 27 and 28. I'm not even too interested in 24 and 25. Now my way of thinking, 24 and 25 are baked into the cake. We see what's coming. We see China and Japan. We see the potential for geopolitical conflict, but we see what Mike Howard talks about and how the total currency in the system, as he calls it, liquidity, is in a position to expand. And we know it has to expand for the U.S. government to continue financing its fiscal expenditures, its fiscal deficits. So it's baked into the cake. It's already coming. It's on the horizon. Like I often talk about that type of story. It's like what could you see? And I could see all of this is right on the horizon, and then it's on its way. Like it's right down the road. It's right there. Can't you see it? It's just a little bit down the road. Just wait a little bit more. And that, to me, that little bit more is probably about between now and H2 2025, second half of 2025, June, summertime. Between now and next year, it's going to get interesting. And 27, 28, heading into 2030, which would be probably like bear market territory, I would expect to see some progress on regulatory clarity from a business perspective, where businesses are starting to be able to consume these B2B products and services. My 2 cents. Which also means, what are you as an investor? You're not investing in a consumer-facing business. I don't think that I'm investing in consumer-facing businesses. I think I'm investing in business-facing businesses that are offering credit and liquidity management services and cross-border services, cross-chain, which is akin to cross-border. And these types of services, payment rails, and ways to facilitate businesses gaining access to capital. So that's very interesting. If you're creating a crypto startup, why are you borrowing capital from a traditional bank? You can borrow capital from uh, a crypto bank of sorts. And obviously you need collateral, so maybe these startups, these businesses are going to be uh, more sound from the get-go instead of the tech sector, which is somehow you build a prototype and you get venture capital involved. But maybe all the businesses that we see, optimistically, are built by persons that have been in these crypto markets and they are successful and they have collateral and they have capital. And if they need to borrow capital, you borrow capital from here until as far as the eye can see. And that capital will create a business to sell products to consumers. So that's probably where we are, and that sounds quite reasonable to me where we're heading. In fact, these time frames, these time horizons are quite comforting. If you can't wait, if you have an inability to be comfortable over the next 4 and 8 years, I think that is the investment hurdle. It's not really, it's at this point, it's not really what to own. It's the time period to own many different types of things. And over the next 4 to 8 years, the potential for this space to expand is extraordinary, and that capital bleeds over everywhere, and that's I think that's baked in the cake. I think everyone knows at this point when capital starts to experience significant inflow, it bleeds over to everything to the point where you get malinvestment, and then you get the reckoning, and then you get folks that preserve capital buying things at a discount somewhere in 2027. Yeah, well, it makes sense. Probably early 2027. It's going to be an interesting time period to inspect between 2026 and 2027. That's not on the horizon yet to understand things how they're really going to play out from a macroeconomic perspective. That's beyond the horizon at this point. But obviously that's coming. So we're prepared and we'll be looking and we'll see exactly what's going on and we'll have much more context, much more historical context to draw experience from, especially after getting through 24 and 25. And then every year after, we'll have that much more experience to draw on and we'll be able to navigate with that much more confidence. Bitcoin looks solid. Damn. 67.5. Hovering, barely breaching 67, 67.1, 2, falling back 68 and change, but now 67.5. I'd love to see a nice breakout at some point. I think that is baked in the cake. Nice strength in the market. Let's check VIX, 12.26. Marginal action, 2.59%. This thing looks like it's going to get crushed all the way down to like 17 levels. I was looking at this the other day and I was like, oh, that's where we're heading. That's crazy. What was going on back in 06? That was like towards the top of the market. That was the top of the market and then everything started to fall apart. You could throw this stuff on the timeline and see when Wall Street was really coming apart at the seams. But things tend to move things move until capitulation. They continue until capitulation. So down. Well, it could be a 14 and it pops back up and then it falls down. Who knows? This is just the volatility indicator. Let's check where we are with regard to bonds. Oh, that explains a little bit of strength in the market, down to 89. It'll be interesting to see if they keep this under control and we finally get the breach below the monthly 200 SMA into the 80s. Probably finds some support on the 100 SMA moving averages because moving averages make sense to have meeting on a volatility indicator. But look at the trend. And what goes up comes down, and what goes down keeps going down until some sort of capitulation event, in which case the trend reverses. Interesting that TLT's up and bonds are, that's interesting. Anywho, who's in the house? Raul's in the house. Air bro, good afternoon. Michael, hi all. He's Arrow. It's Alt Saggy. Whoops. Gazika, hi Captain. Lucian, good morning. I am DC. Hey Cap, I've actually doubled down on my CVX thesis as I see it as a B2B accumulator. So at fully diluted value, the utility and cash flow XYZ is meaningful. Plus it's at a discount. Now that's an investment thesis. Everything you said there completely resonates with me. XYZ. Now if you go over to convex, so XYZ is one of the most critical observations. As you can see, there's a 24.71% APR on VLC VX. It's as simple as that. So 24% is significantly higher than the risk-free rate of return of U.S. government debt, and you're getting compensated for your exposure to risk. Is this effective compensation? Compared to the price point. Effective compensation will be relative to the price point. And as the price point goes down, this relative compensation goes up to a point, and that mechanic, that market mechanic creates a relative price floor. Let's take a look at CVX on the chart. Not the best chart, as I've said many times, but it's hovering around the lows. Low set back in September 2023. That kind of day, 2013, I was about to say. Okay. It's certainly at a discount. Its XYZ is significantly greater than the risk-free rate of return. And fully diluted value is part of the story. Like, it's obviously disinflationary emissions. It's getting really darn close to its supply cap. It's going to be interesting to see what plays out with regard to governance when it gets to its supply limit, its boundary, and there's no more emissions. What does that even mean? And that's all coming. It's all baked in the cake that we'll be able to see what plays out. You know, and obviously that's a very specific asset. And then you got the ECRV, which yields about, if it ever loads, running about 34.91%, or is sky high because that thing just has depreciated monstrously. As it goes down in value, you're able to buy more of it, therefore you get more return. I think it's around 80% APR. I wish there was a nice display for the solidly user interfaces that said what the average APRs are. I guess they do it granularly from a voting perspective. Like if you go over to vote, they give you rewards estimate, vote APR. It's not the most informative column from a voting perspective, but I guess it's a good user interface. Clearly, this is a perfect example of why this stream's title came to mind and why these are business-to-business products. This is very sophisticated. Look at the conversations we've had, Arrow, about what we're doing and why we're doing it and our choices. It's complicated. And it's not simple. And they'll eventually be consumers of these products that are businesses that either are just passed through to some degree and making them simpler, or they're creating a derivative themselves and selling a product that is presenting that simplified user interface that's palatable for a general public consumer. So this is certainly not that, but I'm certainly not intimidated from a technical user interface. So this interface and the granular nature of the information, this makes sense. Why? This was built by engineers. This type of detail is what we need, you and I and other persons of this mindset. This is the information we need to make these types of decisions. And that's meaningful. So a lot of folks, especially the general public, will come in and see a user interface like this and say these user interfaces need to be simpler. No, these user interfaces are not for consumers. These user interfaces are for businesses because the value prop and the offering, the technological product and services that these businesses offer is clear. It already exists. So it's not like they need to stop and pivot and do something different. They just need to find, or the businesses need to start. You can see the Cambrian explosion that's pretty much inevitable. Isn't that baked into the cake? The general public loves products and services. Businesses and entrepreneurs build a business when they can, using other businesses as infrastructure. So there's a lot of frictions right now from a regulatory perspective. As these frictions subside over the next 6 years, heading into 2030, we'll see more businesses come online consuming these businesses, such as the one we're looking at, to facilitate the products that they have in mind for consumers. Hope that helps. It's your birthday, Michael, in the house, getting CVX for it. I like convex. Tetranet always said, vote rentals are unbound, and he always favored convex over base v CRV. I have favored base v CRV because it's the base layer of even convex, and it provides access to cash flow from, at this point, CRV USD plus void rentals. And as we can see, it pays more than CVX. But more is not necessarily where I think everything will be in the future. I think these rates of return will be cyclical. I think we'll cyclically see higher rates of return on convex, higher rates of return on curve. And it'll go back and forth and all over the place. And I also see other products that will offer competitive rates of return. So what's the whole point? The whole point of the statement is a lot of people think in terms of like go all in. And that's why I redefined it, and I think in terms of exposure. So when you have exposure to curve, you primarily have exposure to mainnet. They have a limited footprint on other chains and L2s, so on and so forth. But the L2s have a much more dominant player. Nile is taking its lead on Linnea. If you go over to Arbitrum, hey, positive volume on the week. Camelot and Ramses have been going back and forth a little bit. But Curve's not here, and then that's fine. This is not to diminish where Curve is heading and what it offers from a vertically integrated stack of stablecoin fintech technology. But it's not there. So what is the better exposure to Arbitrum? And that would be, I've chosen Ramses. And I guess that's the expression that I made. Exposure. This is not just enough to get the best APR, because you don't know what the best APR is going to be. The expectation really needs to be that it's going to be cyclical. Things are going to change over time. These markets are dynamic. Maybe one chain is going to have more volume than another in the future. So that's why you make these choices now of what chain, what market you want to have exposure to. More capital that you earn over the years, the more exposure you're going to be able to have. A smaller portfolio just starting out, you're going to be able to have less exposure. You're going to be constrained, restrained. You're not going to be able to engage in all the financial activity you want to. So you'll want to concentrate into arguably the fastest horse from an investment standpoint, or the fastest horse from a cash standpoint. And that's an entire conversation unto itself. Velodrome dominates optimism. I always like looking at Avalanche and Trader Joe. It's just so dominant. It's just so many multiples ahead of anything behind it. It's quite extraordinary to say. Uniswap. Wow, 80 mil. How do you like that? It was always the argument of the Velodrome folks um, to flip Uniswap, and well, look at that, 80 mil vol over 24 hours. If anything's gonna has the potential to flip Uniswap, uh, I think this is very interesting. 80 compared to 160, it's 50% of the volume. That is downright fascinating. Huh. Okay. This is quite surreal. If Velodrome flips Uniswap on Optimism, I think that's the first time ever that Uniswap had a dominant position and was flipped. Huh. That's very interesting. That is, I mean, it's basically there. It's like 90%. Oh my God. This is actually, you're looking at something that's quite extraordinary. Anywho, that's the Velodrome story. So, Optimism, what's your preferred? And look at Curve. That's actually quite interesting too. Number 3. So it looks like we tend to look at the businesses that give us exposure to business activity in markets that are most representative of those markets. These businesses that we've chosen give us the best exposure to these markets. And that's a very simple observation, as we can see in the data. And we didn't have to scramble over social media to find the new hot thing. It's just like, which protocol is doing the best business, the most business activity on a particular market? And that's what I want to own. In the end, I guess experience is quite strange because with experience, you could say in hindsight it was simple. In hindsight, this is the narrative. You look at the business activity, the volume, and those are the businesses I want to own. And that literally, how many protocols do you hear talked about on social media? And they're like, oh, this is the next big thing. This is so exciting. It's incredible. And the hype is extraordinary. And the price action is maybe extraordinary as well. It's not here. It's not present competitively from a volume perspective. To me, that means everything. That's like peering through all the bullshit. It's a big deal. Hope that helps. Being liquid makes it complicated when figuring out what to do with lackluster bags with not great metrics. So if you're not liquid, so let's make it even worse. If you're not liquid with not great bags, okay, it's not complicated because you really can't do anything with it, and you made a purchase, and then you have to live with that purchase. And so that's definitely a consideration. You need to have maximum conviction when making purchases that are non-refundable. Liquid requires a lot of mental effort, a lot of due diligence, a lot of data analysis, and a strict sense of loyalty to rationality. What is the best thing to do? So there's endless choices and options, endless. And that is inherently the complexity with liquid bags, as you say. It's not easy. And no one ever said investing is easy. But heck, we've been doing this for years at this point, and I had to simplify it. Oh my, 16 and 17 was just insane, and I never ever want to be that person again. I don't want to be the person I was in 20 and 21. I want to be not just better, I want to be older and lazy and not have to do the same amount of work. So that really contributes to this overall methodology that I discuss. I hope that helps. Um, it's not necessarily easiest to get to where I am with regard to my capacity to be calm, methodical, stick to operating procedures without doubt, without hesitation, rigorously. That's not easy. But that should be a goal. Everyone needs to define their own goals. But I think the most important goal that everyone should define is to define their rules and then measure your success based on how well you stick to your rules. In terms of, am I cutting too soon versus not? You'll never know. It's all about, did you do good or did you not do good? There's no answer to that. And you'll only be able to measure from significant hindsight. It'll be a year down the road. Could it have gone higher? And I can't stomach that. I've done it, and I've gotten lucky, and I've made good choices mostly, but I can't stomach that kind of behavior anymore. Just needed to do something different. I look forward to chatting about accounting. We'll do that on private Discord. So 107 people that are watching the stream, you will not be able to hear me talk about accounting because you are not subscribers of the most rational community in the entire crypto space, where we discuss the most rational things, including accounting best practices or accounting opportunity. So I think subscription to the most rational community is a rational choice. Leandro, hi Noah, what's your average gas cost for interacting with Curve ecosystem on a weekly basis, trying to understand viable position size for the protocol? So mainnet prices people out quickly. Now during periods of volatility, it is, for a lot of folks, disgustingly expensive to engage with mainnet, to the point where if there's enough volatility and gas prices are high enough, I don't even want to touch it. And I'll only touch things if I have to. I don't really want to spend $60, $70, $80, $100 on a transaction if I don't need to. So, but that's what the gas costs can be when things get spicy. So, Curve is it's a financial walled garden in that regard, especially from a base VE curve perspective. You do auto compounding stuff. That's exactly what the compounder does, part of the Aladdin ecosystem. The compounder, my exposure to the Aladdin ecosystem, where you could do, you go over here, Air Force, you could go to the Pounders, auto compounding, the Union. So there's a lot of options for how to have exposure to CRV. And obviously there's the LSDs. I'm not fond of those because they're liquid, in which case I have too many considerations. It's exactly what Arrow was talking about. So I've said it before, and it's a reality that must be digested, accepted, and overcome. The smaller a portfolio, the harder the choices are. The larger a portfolio, the more wiggle room and the more freedom there is to make different types of decisions. So that's the number one rule for success, is to respect the portfolio. So if your portfolio is smaller, you need to do more concentrated bets. So if you do a more concentrated bet, you need to do more due diligence to assess the risk. And if you want to survive, you got to take less risk. So less risk implies less potential return. But fortunately in crypto, less potential return is still ridiculous numbers. So if you compound that at the numbers that are pretty much expected for good parts of the entire crypto space over the next 8, 12 years, it's going to be quite extraordinary as compared to anything achievable in equity markets from a 401k or a brokerage account. And Bitcoin as well, probably at this point. The end of the dollar is not anytime soon, and Bitcoin is going to significantly appreciate relative to the debased value of the dollar. The dollar will continue to debase, and Bitcoin will continue to go up in value over time. The question becomes relative performance. What is the potential performance of Bitcoin versus the potential performance of fintech startups? Fintech startups that are B2B. and the B2C counterparts haven't even come online yet. So the potential for these fintech startups is like crypto and NASDAQ combined. In my opinion, the potential for these crypto startups, these businesses, is grossly underestimated. It's literally, this isn't even NASDAQ yet. What do I mean by that? This is the infrastructure that is needed just to build the businesses. So what happens when there's 10,000 businesses, 100,000 businesses around the world, not in any particular country, consuming Curve infrastructure, consuming Uniswap infrastructure, consuming the infrastructure. I don't want to call out a particular brand because that's not the point. The point is to understand where the space is heading, where these markets of markets are heading. And I do mention, for instance, like voting, like vote rentals. The vote rentals, I remember when Andre first came out with his user interface, it was a couple of vote rentals, like 3, 4, 5. Now there's a laundry list. That's every week. Look at that. It's all the way down to the bottom. That's got to be like 50? I don't know, 30 to 50, let's say. I'm not counting it. What do you think it's going to be in 2027 and 2028 or 2032? You're going to have 10,000 rentals. At least that's the mindset that I have looking at this. And when I look at this, I think of what I say about charts. Charts continue until capitulation. Do you think this chart's going to get less or more? Is this industry just beginning or coming to an end? Hasn't even started yet because we don't have the B2C. Hasn't even started yet. That's how how early this is. So I hate saying very cliche phrases that are very popular on social media, like still early, because it needs to be understood in context. Early what? With regard to capital gains in a cycle? No, you're not early, because if you were early, you were buying Bitcoin at, let's go to the monthly. Because if you're early from a capital gains perspective, you're buying Bitcoin at 15,600. But you're early from a crypto business standpoint where it's just the B2B getting off the ground. The B2C doesn't exist. And you need to think of that in terms of like a crypto NASDAQ, of the potential scale and scope of businesses that are possible. See, here's the thing about business. We can't sit here right now and think of what kinds of businesses they're going to build, because that's not how business works. Entrepreneurship is an idea. You come up with something and you build it. And that's probably the most exciting thing in my mind right now. And it's uncharted territory of what they're going to build and why they would build it, because I'm not, otherwise I'd build something. I'd be an entrepreneur. But the exciting thing is that this is the infrastructure that will be used to facilitate the products and services of the businesses that are consumer facing. Hope that helps. Tape pusher, is fiat currency debasement objectively unprecedented? No. Lynn Alden speaks about this the best. There's plenty of times in history where it's quite precedented. When I bring this up, all people tell me that it's always been happening. Yes, so we understand it much better, because obviously like 4 years ago I wouldn't be able to have this conversation. It's just not something that I understood. So it's also a generational issue. Like, I'm the oldest of millennials in my 40s, and I'm starting to understand it. The older folks understand it. Obviously, Mike Howell, Ralph Powell, they talk about these topics. Brett Johnson understands it. Lynn Alden understands the history of it. So it's certainly precedented, but it's different. So it's about like being, a meteorologist. Like, what's the weather? So understanding the mechanics of the system and what what forces are being exerted to push the system in different ways. And the way the system is constructed, those forces are tried, the regulators try to manage those forces. And as a result of those forces, the regulators respond trying to stabilize the system. That's the whole point of Keynesian economics, is to manage the peaks and troughs of currency expansion and contraction to maintain a stable, functional financial system. It's basically, by definition, an interventionist system. Historically, I mean, look where we are with regard to technology. Um, they were limited in their capacity to intervene, and now they're just unlimited in their capacity to intervene quickly, faster than ever before, to manage a stable and functional economic system. It's always been an interventionist system. That's what do you think the Fed funds rate is? They're adjusting the Fed funds rate to manage the amount of capital that commercial banks can create, the amount of currency that commercial banks can create, either creating a loose or restricted financial condition. It's intervention. It's really built into their core policy. Fed funds rate. It's artificial intervention into an economy that, if it wasn't for that funds rate, banks would be assessing risk and inspecting balance sheets of their counterparty banks before lending them something. And look at the central clearing of treasuries that Gary Gensler has been talking about. All of that is to reduce risk, to streamline clearing and find a counterparty and matchmaking, and to make the treasury market operate smoother than ever before. This is all artificial intervention, albeit that's probably that's at least the structure. But the problem there, in my opinion, would be like mandating. People have to use it. You should offer it, and it should be better than something else. Offer better conditions, less risk, and that's why people will choose to use it. That'd be an organic market rather than force and enforcement. So that's the reality. And the better you understand the reality of the way the system works, the better you get a sense of where we are and where we're heading. Hope that helps. It's a good one, though. Seems like last 3 or 4 Ramses is paying way more to LPs versus voters. Uh, sure. And then that is an observation. I find that Nile is paying significantly more than Ramses. I found a bit of a voting strategy that I think I'll be consistent with. Um, but overall, there's no other better exposure, in my opinion, to Arbitrum. Not too fond of base VE from a Camelot perspective. Now, that doesn't diminish it. I'm sure folks that listen to me maybe have exposure to Arbitrum vis-a-vis Camelot, and that's okay. Clearly, you can't have exposure to Arbitrum vis-a-vis Uniswap unless you're a liquidity provider. But that's not something I would argue is for small financial actors. That's for someone who could throw around some serious cash and hedge accordingly. Hedge in permanent loss, hopefully. So LPing is not for the faint of heart. So there is not. It's not as cash flow positive as Nile, which has just been a little money printer. But this is a microscopic network. Look at the size of the network. Arbitrum is doing 313 mil. Little Linea is doing 31 mil. It's 90% less volume. All as compared to Ethereum mainnet, which is doing $1.3 billion worth of financial activity on a 24-hour period. 18% week over week in the green on volume. No wonder the price action is looking a little bit more favorable today. Fair amount of financial activity. It's a good observation, Leandra. Good point. Tape pusher with potentially 130 trill coming into circulation. It's still precedent, really. It seems gigantic. Yeah, well, it's because of debt. So the more debt in the system, it gets into the debt-death spiral that Luke Roman talks about so well. Um, they need to kick all of that debt, and kicking all of that debt means refinancing. So for that refinancing, you need what Mike Howe talks about as balance sheet capacity to actually refinance. So that means the currency supply needs to expand uh, to to actually accommodate the amount of refinancing that's required. Um, it's precedented, maybe not at this scale. Um, if relative scale, sure, but and that's fine. Maybe if you're looking at it not relative, and then these numbers are absolutely astronomical, and that's fine. But that doesn't mean on a relative basis we don't have things play out like they did historically, and that's what Alden talks about. And we talk about. I've heard stories of post World War II, and you probably go back to previous economic systems of various countries around the world and get a little bit of precedence. So maybe that's an interesting point. Like all historic financial systems have failed in a blaze of glory. But that might not be the biggest takeaway. The biggest takeaway that, oh, the dollar is going to end, they're going to stop using it. Yeah, okay, that's cool. When? Because if it's going to end in 50 years, and what does end mean? Like overnight? It just stops working? So it's important to really dig in when someone says very terminology that has like very constrained time frames, because and you realize it doesn't make any sense. So if this is unprecedented and it's going to lead towards decay of countries around the world wanting to hold U.S. debt, that's going to restructure the debt market. The dollar seems like it's entrenching. Independent considerations. Do you not have decades? It's not on the horizon. He can only respond to things really on the horizon. So if it's a decade out or 2 decades out or 3 decades out that Treasury bonds are going to be used less and less, all right, so that seems like Treasury bonds are a pretty shitty investment. So dollars are nominally increasing, dollar liabilities. So that means on a relative basis compared to consumer prices, the value of those dollars are going down. That's consumer price inflation or currency debasement, currency inflation, whatever terminology you want to use, which implies you need to try and account for that from a financial perspective, which means you can't really save in dollars. Albeit you can, because you could swap between FX markets opportunistically and then back into dollars when the dollar is appreciating. Because we clearly have a history, and it's cyclical, where the dollar goes up. Because the dollar has been in a bull market since 2008. So, see, this is why it's hard. That's why capital management is so hard. Folks are like, the dollar is going down. It's going to go down in a blaze of glory. No one's using it anymore. The dollar is only up since 2008. I'm trying not to yell because I've had comments about that. It's only up. It's literally, look at the chart. That's crazy. Let's go out to a 3 month. And this is a great perspective to have. Everyone complaining that the dollar is down and it's coming to an end. Meanwhile, it has only gone up in strength since 2008. Period. So, and then they'll say, but it's relative. Yes, that's the whole point. It's relative. It's relative to other countries. And that's what Brent Johnson says. It's the cleanest, dirty-ass shirt in a pile of dirty laundry. And that's why the dollar is the last currency standing. Fortified, certainly, by the denomination of debt and how folks expect to get repaid on debt that is owed to them. And they're expecting their dollars. Cleanest dirty shirt in a dirty ass pile of laundry. Yeah, might not be really precedented, but at least relatively it is precedented. 130 trill is FUD. I think it is. Actually, in all seriousness, I think that is. I think it's small. Um, if they have to refinance 10.8 trill at min plus deficit spending, uh, the world's not going to leverage that really 10 to 1. They go absolutely crazy. Let's say 50 to 1. Oh, there you go. There's a half a trill coming in, a half a quadrillion coming into circulation. Half a quadrillion. Oh my God. Gotcha. So the number's unprecedented, but 130 trill isn't what it used to be. Yeah, that's a good point. It's all been debased, and that is part of the inspection to be made. 130 trill, you're talking like a 10 to 1 leverage on the amount of money, U.S. government debt, that needs to be issued in fiscal 2024. So that's true compared to how much currency is in circulation. And by currency, I mean dollar liabilities. There's a, there's a lot of trillions. I don't have a capacity to speak particular numbers, but merely by that inspection alone, if you're going to issue 10.8 trillion refinancing of fresh on the run treasuries and they leverage it 10 to 1 and inflate currency supply by 100 trill, you can only imagine what they've been doing with the debt that's in circulation for decades. It's not rehypothecated 10 to 1. It's rehypothecated many more times. So that gives you a sense of not only how big the system maybe is currently, and how 100 trill would fit into the current composition of the system. It might be small, which is a pretty scary thought. Finance Goblin, Mr. Noah, have you researched f of x? Yes, indeed. Someone asked me that almost every stream at this point. I am exposed to Aladdin vis-a-vis the concentrator. F of x is a very quality and interesting business involved with stablecoins. And they have their finger wrapped around the concept of vote rentals. So they understand incentive systems, they understand liquidity, and they know how to get the liquidity by opportunistically using incentive systems. I have a high opinion of the Aladdin ecosystem, and I have my exposure, my chosen exposure to it. Hope that helps. What's a half a quadrille between friends? Yeah, bear in mind, it's all relative, though. So, this chart is what's pertinent. If a half a quadrille of dollars liabilities is added to circulating supply, but on average, the rest of the world creates a similar amount of currency supply, this chart would be unchanged, and the dollar would have the same value. What matters is currency supply may be chasing goods and services, so the pertinent observation is that currency supply being added to the financial economy or the real economy? And I would argue they're going to try very hard to keep it constrained to the financial economy, which would be banks, stocks. They're not really going to be able to do much about crypto. So it's just going to bleed over into significant inflation in these parts of the economy, or rather this economy, the financial economy. Now, interestingly enough, that's inflation. People talk about housing inflation. That's inflation. The price goes up. Inflation just means price go up. Deflation, price go down. So if the price of crypto assets goes up, the price is inflating. And that means folks are able to sell for more units of account, more dollars. And then the inflation in one market has a way of bleeding over to inflation in other markets. For instance, if a lot of people make a lot of money in equities or crypto, and they have a lot of dollar purchasing power, and they're buying goods and services in the real economy, that contributes to the prices of goods and services potentially going up. So inflation has a way of bleeding over from market to market. Now, it's all relative, and I think China is the biggest driver. They devalue their currency. They're maybe not as explicit as me just saying it, but that's what they have to do in order to counter domestic deflationary pressures. If the prices are going down, they need to stimulate economic activity, which means get people buying goods and services to bolster prices, to move inventory, to create demand. So that's exactly what they're doing. It's exactly what they're doing. And as they're stoking inflation in China, that's increasing their productivity, and that means there's a whole lot of products and services that they're trying to sell that are cheap because they're trying to produce so much of it to counter deflation. And the inflation is producing a lot of stuff that they're trying to export. That's why you're getting these remarkably incredible technologies coming out of China, and especially electric vehicles, quite impressive electric vehicles for relatively cheap prices. So what happens is when they're pushing inflation, they're trying to export deflation. And as they try and export deflation, countries will do their tariffs and whatnot, but it'll make its way throughout the system over time. And just as China did, how do the other countries counteract that deflation that has been exported? By pressing on the inflation, by pressing the gas pedal, reducing interest rates, and providing incentives in the economy to increase financial activity and prevent the decrease of prices. So it's not as simple as folks think. It's quite complicated, and there's a lot of pressures in the system and a lot of knock-on effects, how one thing affects another. And it turns out it's gotten so cyclical, as Raoul Pal talks about. It's become like clockwork. And it makes sense. And it's coming, and it's on the horizon. Between now and a year from now, this is going to be a very interesting space of business-to-business products. And I'm more interested in the business-to-consumer products because they're going to use these business products. What kind of like investment season is over? You know, I've said this phrase many times. It's completely over. Like, what else are we going to get? What else is to buy? We have our exposure to all the meaningful networks. There's nothing else. So once you've exhausted investments, now you do what Warren Buffett does, and you're accumulating cash flow and capital, waiting for the cyclicality of markets to present either discounts or for entrepreneurs to present you with additional investments that you need to make sure at a discounted price, especially if there's a frenzy going on in markets. So that's kind of where we are. That's the sit rep for Monday, May 20th. You just can't keep throwing capital. You got to wait for a discount. So in my opinion, discounts are over, and it's kind of sit back and relax and let the next 1 year play out and accumulate capital along the way and strap in, and you're along for the ride. You're just sailing at this point. Taps is in the house. Yo, bit late. What's up, y'all? Yeah, another day, 12:58, my friend. Welcome. I think we'll wrap it up though. Anything in the charts that are interesting? I don't even need to really look at Ethereum. I tend to look at Bitcoin nowadays. You know, Ethereum, I don't think of Bitcoin nor Ethereum as investments. I think of them as cash. And I like the Bitcoin for cash at this point. Use it as collateral, so on and so forth. You could do the same thing with Ethereum. But that's just my 2 cents. Become a Bitcoin maximalist in my old age. Maybe I'll title an entire stream How the Captain's a Bitcoin Maximalist and explain what the hell that means. I think that'd be a good conversation. Considering everything that I talk about, how the hell am I a Bitcoin maximalist? Yeah, but in my crazy ass mind, that shit makes sense. Okay? Trust me. Monday, May 20th, 12:59 p.m. Thank you all for joining me. 132 people made it to the end of the stream in pursuit of rationality. Thank you for joining. Tell everyone to subscribe. After party is always on our Discord server, the most rational community in the entire crypto space. I wish everyone a good day. I will see you later this week. Stay rational, my friends. Peace.